everyone. I hope everyone's enjoying the time in Bangkok. I know I am. I got here about a week ago and went to the staking summit last week. Learned some really good insights there. So my talk is a deep dive into the Web3 insurance market, and I started preparing for this presentation maybe 2 or 3 weeks ago, and basically when I went back and looked at it on Monday, a lot of the data points that I'd already prepared had changed. Obviously, there's been quite a few developments in our industry and in Web3 since then, so I had to basically redo all of my data. I guess just a caveat, everything I'm going to say, we're in a fast-moving industry, things change, and it's a really exciting industry. So I joined the Chainproof team 6 months ago. Before joining, I was an underwriter at Allied World, and I was underwriting cyber insurance for Fortune 500 companies. So I'm new to the Web3 space, but I've got a really fantastic team behind me at Chainproof and QuantStamp. So with that in mind, let's go into the presentation, hopefully. Christoph? Okay, thank you. So for those not aware, Chainproof is a Web3 insurance company. We're incubated by QuantStamp, a leading blockchain security auditing company that secured over $200 billion in digital assets. But while code audits are vital, they're not always enough, and that's where insurance comes in. We are regulated by the Bermuda Monetary Authority, one of the first Web3 insurance companies to be regulated. And we're backed by Sompo, Japan's second largest insurance company, and we're reinsured by Munich Re, the world's largest reinsurance company. So what we provide, slashing insurance for any proof of stake chain, and smart contract insurance with discounts on QuantStamp audited contracts already. Christoph. So what I wanted to do as a starting point for my presentation was to think about the Web3 insurance market. And my research showed there's over 30 companies active in the Web3 insurance space, which is really exciting. And the first thing I wanted to think about was what the potential total addressable market might be. And to do that, I looked online and saw that the total amount staked is around approximately around 700 billion. And I added that to the total value locked into smart contracts, approximately 100 billion. So it gave me a figure of 800 billion. So what I went from there, and this is obviously theoretical, but what I took from there was potentially maybe 3% of that is revenue for the protocols and the validators. And I said, maybe the insurance companies can charge approximately maybe 3% premium of that, which gave me around 9 basis points. So that gave me a figure around 720 million potential total addressable market. Now, depending on how conservative or aggressive that you think about things, I think for the sake of this presentation, we could maybe say that's between 1 and 100 basis points. So that would be between 80 million and $8 billion. So, but the main real point of this slide is to think about how it compares to the other two figures on there. And as we can see, and this data is from OpenCover, there's approximately 300 million TVL in insurance protocols. So how does that relate to, obviously, the potential market size? If it's potentially up to 8 billion, well, it's quite a lot smaller, and there's not enough capacity to cover the total market. But also, how does it compare to the 100 million of active cover in insurance protocols? So this is cover that is active, so it doesn't include expired coverage. And so obviously that's a lot less than 300 million, so that's telling us that there's of the capital available, it's currently being underutilized, so we're underutilizing the resources at the moment. So in terms of this 300 million, there's a few things in TVL. There's a few things to think about this. Now, not all of this is necessarily underwriting capital, which is the amount of money that insurance companies typically set aside to pay for claims. So there's other things within here. So for example, insurance companies set aside money for things like yield farming, governance, operational expenses as well. But for the sake of this discussion, we're going to think about this 300 million as a theoretical amount of underwriting capital. And then the other thing is think about the capital utilization rate. So if most traditional insurance companies have maybe a 3 times or a 10 times capital utilization rate, meaning if they have $1 in the bank, they can maybe write up to $3 of risk, or maybe between $3 and $10 of risk. So if we're basing that even on the most conservative amount, 300 million times 3 is 900 million. So it's still quite short of the total addressable market, or potentially up to 8 billion. So let's move forward with the presentation and think more about as we go a bit more granular, and we'll have a look at some of the on-chain data from Nexus Mutual. So essentially, in terms of the coverage distribution, they're predominantly selling insurance against hacks for protocols. But the more interesting part, potentially, is the insights between 2023 and 2024. So in terms of the amount in premiums, last year it was 1.3 million. This year it's gone up to 4 million. So they've actually come out of quite a difficult year, because they've paid over almost 9 million in claims, and they've paid 18 million since their inception, which was 5 years ago. But this year has been much more promising, as they've boosted the premiums from 1.3 million to 4 million, and they've only paid 5K in claims this year. And then some of the things to think about on this slide as well is the capital utilization, so about 230%. So there's room, I would say, to sell even more insurance there. And if we think about the first slide, when I was speaking about what the potential market is in terms of basis points, in 2023, it was, if we look at Nexus's data, it's 37.5, and in 2024 it's 69. So if you remember, I said maybe between 1 and 100 basis points. So this is kind of approximately in line with that. And they've obviously paid out on some really high-profile claims as well, like FTX, Rari Capital, Euler, and I'll talk about that a bit more in the next slide when we talk about challenges. So we've spoke about the total addressable market, and now I think it's time to talk about some of the challenges that Web3 insurance companies have to meet that market. So the reality is there's quite a low demand for DeFi insurance at the moment. It's not mandatory, and many projects perceive audits as enough, that they don't necessarily need insurance. But as we can see, according to Immunify, there was $1 billion lost to smart contract hacks last year, and then in the first half of this year alone, it's over 1.2 billion. So the risk is increasing, but the demand for insurance necessarily isn't increasing along with it. So one of the things that I was thinking about here is there's been quite limited claims activity in relation to the amount of losses. So for those of you that know about the Lloyd's of London, so in in 1906, there was a really bad earthquake in San Francisco. And what the Lloyd's underwriters did is they actually went all the way to San Francisco and set up a stand and were paying out claims, giving cash to people and giving cash to people in hand. So what this did, okay, they paid out a lot in claims, but what this did is it boosted the value of insurance, and people saw the value in it. So from there, the insurance industry skyrocketed. And if you think about to the data that we just looked at with Nexus, they paid out $9 million in claims last year, but their premiums grew 4 times this year. So it's counterintuitive, but maybe the insurance companies, if we start paying out more in claims, will boost the appeal of insurance. So I'm going to pivot now a bit more to the off-chain side of things, and products that are gaining interest. Obviously, Chainproof is an off-chain insurance company. Are the following things like slashing insurance, smart contract, D&O. So we'll also be writing D&O insurance next year. Custody insurance. So there's a certain bundling effect if you can offer all of those contracts, all of those policies. And then customer personas. So as I mentioned, I was at the staking summit last week and spoke to many node operators, and many of them believe obviously they'll never be. There's a very very small chance that they'll be slashed, and the appeal of insurance is more to do with marketing. So how can they market to their clients, but also is what institutionals are asking for as well in terms of insurance. And brokers, I think, are very useful for more traditional lines like D&O insurance and things like that, but not quite as necessarily up to speed with the latest Web3 products like smart contract and slashing insurance. And I would say the key differences versus on-chain is with off-chain insurance, there is no one-size-fits-all necessarily. So our insurance policies can be very tailored specifically to what the customer needs. So I'm thinking about, like, in terms of retentions, co-insurance participations, how you build the policy is very, very customizable. And this is also an educational journey for many of our clients because they have to think very carefully about their actual risk appetite as an organization. You know, do I want a policy that is meaningful with a very low retention, or do I want a policy possibly for more marketing reasons or whatever with a very high retention and obviously a smaller premium? So there's a lot of reflection happening as well within the market of people that are thinking about what kind of insurance they want to buy. And obviously the regulatory backbone of the BMA, for example, for Chainproof, is also really important for this market as well, because it's more of interest to the institutionals. So comparison, I won't spend too much time on this slide, but the on-chain insurance is more standardized, automated, can automate the claim settlement. And the off-chain insurance is much more customizable, but with a longer claims cycle, with claims more likely to be manually reviewed and a bit more time. And whereas the on-chain is typically for more Web3-faced users, off-chain is more focused on the institutional side. So in terms of opportunities, yeah, there's a large gap, obviously, between the total addressable market and the current capacity available. There's also a rising demand for new products. So one of the great things about working in this kind of industry is there's loads of different innovative ideas for new kind of insurance. Like one of them, for example, is insurance on staking yield. You know, and that brings up questions, you know, how do we as insurance companies underwrite this? And And I think a big opportunity as well is the clarity in the regulatory frameworks. So obviously, as they evolve, clearer guidelines boost the adoption in decentralized finance. So thinking of conclusions, demand obviously at the moment for insurance is currently weak, but the underlying market potential is completely enormous, and we need to focus on expanding the capacity and also educating the market to be prepared for a surge in demand as the ecosystem matures. On-chain solutions obviously excel in the automation, but possibly lack the flexibility, while off-chain solutions are more customizable and compliant. Institutions are increasingly seeing the value in insurance for both compliance and marketing reasons. And I believe that the future of Web3 insurance will see a convergence where the on-chain and off-chain blend. So yeah, that's it. Thanks a lot for your time. I'm happy to answer any questions as well.
Thank you very much, Ben.